Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ELEVANCE Health Inc. annual report. ELEVANCE Health Inc. offers a wide range of businesses and services through its four segments: health benefits, Carelon RX, Carelon Services, and corporate and other. The company provides health plans and services to various members, including individual, employer group, risk-based and fee-based, Blue Card, Medicare, Medicaid, and FEP members. In addition to health plans, ELEVANCE Health offers a variety of products and services, such as stop-loss, dental, vision, and supplemental health insurance benefits. The company also operates in the pharmacy services business, providing home delivery and specialty pharmacies, claims adjudication, formulary management, pharmacy networks, rebate administration, and prescription drug database. Furthermore, ELEVANCE Health provides healthcare-related services and capabilities, including specialty care enablement, utilization management support, behavioral health and comprehensive care management services, palliative care services and management, virtual care, payment integrity, subrogation, clinical data exchange, research and data, reporting and clinical analytics, information technology, and business process support services. The company also manages home health, post-acute institutional management, and durable medical equipment costs, as well as supports plans in managing home and community-based services. ELEVANCE Health provides its services under the Anthem Blue Cross and Blue Shield, WellPoint, and Carelon brands. The stock price of ELEVANCE Health Inc. has experienced a significant decline over the past year, exceeding minus 11.72%. Several key events have contributed to this drop. In January 2026, industry-wide concerns were triggered by United Health's earnings announcement, which led to an 11.4% fall in ELEVANCE Health stock. This was followed by ELEVANCE Health's own Q4 2025 results and cautious 2026 outlook, which further impacted its stock. The company projected a low single-digit decline in total operating revenue for 2026 and adjusted diluted earnings per share, EPS, of at least $25.50, below Wall Street expectations. Additionally, the company faced challenges due to shrinking Medicaid membership, rising costs, and reduced outlook. By August 11, 2025, ELEVANCE Health had already experienced a 20.3% year-to-date decline. Ongoing regulatory uncertainty and policy changes have also weighed on the stock's performance, including an unfavorable Medicare rate decision. These factors have contributed to an increased risk premium for stocks in the healthcare sector, leading to ELEVANCE Health's significant stock price drop over the past year. The primary drivers of revenue growth or decline for the company can be summarized into several key areas. Revenue growth is primarily driven by an increase in premiums, which rose by 14% in 2025 compared to 2024 and 15% in 2024 compared to 2023. Additionally, product revenue saw a significant jump of 25% in 2024 compared to 2023, contributing to the overall growth. However, service fees experienced a decline of 1% in 2025 compared to 2024. On the other hand, revenue decline is attributed to several factors. The company faced significant losses due to settlement agreements, including a $604 subscriber settlement agreement and a $666 provider settlement agreement. Ongoing litigation and potential losses also had a negative impact on revenue. Furthermore, the fair valuation of CMSI assets resulted in a decrease of $106 in 2024. Other factors that affected revenue growth include interest rate swaps, options, collars, and futures, which collectively contributed to net gains or losses. The company's segment-specific revenue growth and decline also played a significant role, with the health benefits segment being the largest contributor to total consolidated revenues. Net income and profit margins have experienced significant declines in recent years. From 2024 to 2025, net income decreased by 5.3% due to higher losses on financial instruments and increased benefit expenses. This trend continued from 2023 to 2024, with a decrease of $310 million. The decline in profit margins can be attributed to several factors. Rising healthcare costs and increasing operating expenses have contributed to the decrease. Additionally, changes in membership levels and mix, regulatory changes, and uncertainty surrounding payment rates for Medicare/Medicaid dual-eligible plans have also played a role. Furthermore, the company has faced challenges related to data corrections and uncollectability of receivables, as well as inadequacy of underwriting assumptions. compliance with federal and state healthcare laws and regulations has also been an issue. As a result, profit margins decreased by 13.4% in 2025 compared to 2023. The effective income tax rate also decreased from 24.5% to 15.6% due to discrete non-operating tax benefits and favorable resolution of uncertain tax positions. These factors have collectively contributed to the decline in net income and profit margins, highlighting the need for the company to address these challenges and adapt to changing market conditions. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the data provided on page 76, the net cash provided by operating activities has been steadily increasing over the past 3 years. In 2023, the company generated an impressive $8,061 million in net cash from operating activities. Although this figure decreased slightly in 2024 to $5,808 million, it still represents a significant amount of positive operating cash flow. Furthermore, in 2025, the company's net cash provided by operating activities rebounded to $4,290 million. Overall, these figures suggest that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. This trend is a positive indicator for the company's long-term financial health and stability. The company's debt level has undergone significant changes over the past 2 years. Initially, total debt decreased from -$150 at December 31, 2024 to -$28 at December 31, 2025. However, a closer look reveals that long-term debt has actually increased, with the 5-year facility rising from $4,000 million to $5,000 million and total long-term debt increasing by plus $579 million, plus 2%, from 2024 to 2025. Furthermore, the company has issued new debt totaling over $3.5 billion in the past 2 years. In terms of interest expenses, there is a clear trend of increase. Interest expense has risen from $1,185 million in 2024 to $1,402 million in 2025, representing an increase of 19% from 2024 to 2025 and 14% from 2023 to 2024. This significant rise in interest expenses suggests that the company is paying more for its debt obligations. Overall, both debt level and interest expenses have increased substantially over the past 2 years. The company's management is optimistic about its outlook, driven by a clear strategy to grow the health benefits segment through strategic acquisitions. The recent purchases of Centers, CareBridge, and Paragon are expected to enhance the company's offerings in this area. Additionally, the implementation of a business efficiency program will optimize physical footprint and improve operating efficiency. Management is also focused on maximizing total return in investment portfolios, while prudently allocating capital for share buybacks and dividends. This approach demonstrates a commitment to shareholder value creation. Furthermore, the company is taking a proactive stance against lawsuits, vigorously defending its position in cases such as the Blue Cross Blue Shield antitrust litigation. Overall, management's strategy appears to be centered on driving growth through strategic acquisitions, improving operational efficiency, and maximizing returns for shareholders. This approach suggests a confident outlook for the company's future performance. The company has made several strategic acquisitions in recent years. In December 2024, it acquired Centers Plan for Healthy Living LLC and Centers for Specialty Care Group IPA LLC, expanding its healthcare services. Additionally, RSVQOZB LTSS Inc., doing business as CareBridge, was also acquired on the same month. Furthermore, the company made equity investments in Mosaic Health and Liberty Dental, demonstrating its commitment to diversifying its portfolio. In terms of divestitures, while no specific transactions are mentioned, the company acknowledges that it regularly divests businesses over time. This suggests a strategic approach to managing its assets and focus on core operations. The company's financial activities have been a subject of interest for investors and analysts. A review of the extracted summaries reveals that the company has indeed engaged in 2 significant practices: buying back shares and paying dividends. Regarding share buybacks, the company has made efforts to repurchase its own shares, as indicated on page 43. This move is aimed at increasing shareholder value and potentially boosting stock prices. However, it's essential to note that this practice can also be seen as a way for companies to return capital to shareholders without actually distributing cash dividends. On the other hand, the company has consistently paid cash dividends, as mentioned on pages 44 and 63. This is evident from the dividends reinvested notation in the performance graph and the explicit statement that the company has paid cash dividends. Furthermore, page 157 provides a specific example of dividend payments made in 2025, totaling $1,611 million. In conclusion, while the company has bought back shares to return value to its shareholders, it has also maintained a consistent practice of paying cash dividends. This dual approach demonstrates the company's commitment to rewarding its investors and maintaining a strong financial position. Concerns about inventory buildup and supply chain disruption. The possibility of inventory buildup or supply chain disruption is a pressing concern in the current scenario. The extracted summary highlights potential issues with claim processing and submission patterns, which may indicate underlying problems with inventory management and supply chain operations. These concerns are further exacerbated by the consolidation among healthcare providers, which could potentially impact supply chain operations. Additionally, general risks such as public health crises, labor shortages, and reduced operations or shutdowns of businesses and schools pose a significant threat to supply chains. While these issues are not directly related to inventory buildup or supply chain disruption, they do contribute to an environment that is conducive to disruptions in the supply chain. As a result, it is essential for stakeholders to be aware of these potential risks and take proactive measures to mitigate them. That concludes the financial summary for Elevance Health Inc. Feel free to comment below, and I will be happy to answer them when possible.